Welcome to the Broken Pie Chart Podcast, episode 327. I'm your host, Derek Moore. Things that people thought would happen that didn't. That's going to be one of the themes for this show. We'll get into, had a question about calendar spreads and diagonals. We'll get to that later. We had NVDA earnings, couple things going on here. First, I want to talk about inflation or the lack thereof. Now, I want to remind people that the University of Michigan sentiment question, survey, whatever you want to call it. I don't know who these people are that they're surveying or how they're reaching them. But as recent as May, the May survey, I believe it was the expectation would be the 1-year inflation would be 6.6%. 6.6% is what this sentiment indicator thought about. And they put in, because of tariffs or whatever policies. Well, what is actual inflation telling us? PCE, which is the Fed's preferred inflation gauge. So this is the PCE, the price index. Yeah, no, it 2.147 was the year over year. And that is the lowest level going back to, let me see. I think that's the lowest level. Where would that be? Probably February 21, but 2.1. And then you say, okay, well, energy has been going down. Sure, that's the case. But if we look at the core PCE, which excludes food and energy, obviously people are still buying food and energy. But yeah, let's exclude that. 2.52%, also the lowest since probably, maybe March of 21. So this goes in the camp of what everyone thinks is going to be true often isn't. And I know some people will say, well, wait a second. We haven't seen the effect of tariffs yet and this and that. And that may be the case. But so far we haven't seen an explosion in, at least looking at the CPI. Now we'll get another reading. Usually it's mid-month. Somewhere around the 14th, 11th. I guess I could look it up, but it's going to be right around there. And sure, we could see increases. And I looked at the core PCE, or actually the just normal PCE. If you look at what was interesting is durable goods and non-durable goods. Durable goods, non-durable goods. Goods, things that are made, things that are imported, things that have parts that are being imported. Durable goods actually went down in April. They went down in March. The last time they had a plus month over month was May of 23. So non-durable goods did go up 0.243%. But yeah, you look at this and what was the big driver of it? The big thing is healthcare. Healthcare and let's see, housing and utilities and healthcare. Those were the big ones. And, services was up what was services? Yeah, of services over 2%. So look, all I'm saying with this is the University of Michigan sentiment survey is saying, oh yeah, we're going to have 6.6%. The expected inflation when you ask people. How they came up with 6.6, I don't know. But that's what they said. But what we're seeing in the PCE, which is what the Fed has said, is their preferred measure, and I'll explain the difference between PCE and CPI. But there's inflation still going down. And if you just covered up your ears, covered up the headlines, and you just looked at it, you say, well, it's going down. And the argument is that maybe they should be lowering rates. Now, remember, the Goldilocks scenario is rates stay stagnant or stay even, and the markets are still going up. The economy is still going well. We'll get to the Atlanta Fed GDP. But let me get back to the CPI. So the CPI is, all right, without going too wonky on you, PCE is, it's less sensitive to CPI. And part of the reason is it adjusts for weight, it adjusts its weights. So a lot of times PCE its weights will change a lot depending upon what consumers are spending on. CPI, on the other hand, uses what's called a fixed basket of goods or fixed weighted basket of goods, meaning you don't buy as much soup as you do gasoline, but that doesn't change as much. So the Fed, and I think this was Fisher, I forget who kind of came up with this, but they said, the PCE is their preferred measure of inflation. So, is it 2% is their target? Well, you're 2.147. All right. Congratulations, Fed. You're almost there. Going back to the reason I'm bringing this up is it's really hard to make predictions in markets. And it's really hard to, when you think you know what's going to happen, doesn't necessarily happen. The obvious thing sometimes that everyone thinks is obvious may not happen. It's part of the reason why we like to stay invested, but be hedged. Stay invested, but be hedged. Because you can't really, when you try and pick tops and bottoms, you try and pick when to be in the market, when to be out of the market, you have to be right twice. You have to know when to get out and when to get back in. And those two things are incredibly, incredibly difficult. All right, I want to get to NVDA. And NVIDIA had earnings that were out and they gave some guidance. But one of the things I like to do is look at a chart of the forward PE. So what are the 12-month forward analyst estimates, not actuals, but estimates, and then look at the forward PE, the forward price to earnings multiple. So you take the 12-month forward consensus estimate and you get that in, you put that into the price. And recently it was 28.247 was the forward PE ratio. And you might say that's high. And well, it is higher than it was at the bottom in April when I think it dipped below 20 times. I think it was 19 and change, maybe 20 forward PE. So it's up from there. But I will also tell you that their 12-month forward consensus estimates is right now, if I got a mouse over this, just about $4.80 a share. So, and on a chart, it looks like their forward estimate is just around the high before, Liberation Day, April 7th. So why am I bringing this up? This stock has gone higher in general as the forward PE has been coming down. What does that mean? That means as the stock has been going up, it has gotten less expensive on a forward price to earnings ratio. Does this mean that the analyst estimates are going to be correct? I mean, analysts are pretty good, especially when it comes to the S&P, of making estimate targets. And look, we don't know what's going to happen, but I just think it's interesting that there's a lot of talk right now about valuations in the market. Look, I don't know what's going to happen in the market. I don't know, is NVIDIA priced correctly? Is it underpriced, it overpriced? I'll let you know when I know in 6 months. I'll tell you what happened. But the point I want to make is that they have their earnings or their forward estimates are at the highest they've been, yet their forward PE is lower, meaning the price that investors are paying for the company is dropped. If you go back and you say, well, and I don't want to cherry pick this because I could look at November of 21 when the forward PE was, over 140 times. Remember, it's 28 today. Or I could go to May of 23 when it was 62 and change. Let me see. Was it 62? Yeah, right about 62, 63. But let's say you just go back to sometime in 21. And I'm going to pick kind of the median, 48 times. So if you're at 48 times, and by the way, I'm not saying it's going to go back to 48 times, but you kind of look at this and you say, if it was trading at 48 times, it would be trading around $230. It's closed the other day at $135.13. So this is why it's difficult to try and make predictions on stocks because you don't know what the forward multiple is going to be. Stocks trade on perceived future information. What the street thinks is it knows about a company, but you just don't know what the forward PE is going to be. And obviously it sold off with everything in beginning of April. But anyway, I thought it was interesting. And remember, people make a big deal about the Magnificent Seven. NVIDIA was not in the top 10 market cap weighted companies, even probably 5 years ago, 10 years ago, certainly not. So the index is always changing. There'll be new entrants that come in. There'll be current entrants that leave. Microsoft is one of the few ones that's maintained its position in the top 10 valued companies by market cap in the index. And they've been a little bit of a different animal there. Exxon used to be, AT&T used to be in the top 10. Those are no more. So just thought it was an interesting thing with NVIDIA. I don't think they blew the doors off their earnings. I don't think they necessarily disappointed, but it is interesting. Their valuation is not as high as it once was. Don't know if that means it's going to go up or down. If you want to buy it, you buy it. If you don't want to buy it, don't buy it. But it's just an observation. The other theme, kind of sticking with the theme here, is what you think is going to happen doesn't necessarily happen. Sell in May and go away. Nope, not this May. S&P was up over 6%, NASDAQ up over 9%, small caps over 5%. And you look and remember, people started to say, well, you should buy international because the U.S. is done. And maybe it is. But EM was up, 4.5%. Developed rest of the world, ex-US, up around 5%. So still did well. Gold was down. It was kind of flattish, a little bit down. Bonds were down. If you look at the AGG, about 0.5%. So, it's anyone who said, well, everyone knows the market's not going to do well in May, you got to sell. Nope, not this May. It did just fine. In fact, we are, not that far off relative to where we were in April, off the all-time high. So one of the interesting things, I think Richard Bernstein had a chart. I don't remember who tweeted this. It might have been Sam Rowe, but if I'm getting that wrong, apologize. But it does credit to Richard Bernstein. And it's since 1990 through April of 2025. It's a chart, the S&P 500 percentage of stocks that outperform the index. And the median is 49%, meaning half the stocks really don't outperform the index, half the stocks do. Pretty much. Well, 49.51, so less than half, but you get the idea. And 23 and 24, it was very low, only about, 25 to 30% of stocks outperformed the index. Part of the reason why that was is because you had some of the big market cap weighted stocks were definitely carrying the water for a while. But then you look, and this is 2025 as of 4/30/25, so now it's a month old. But I still like the chart, and I'll talk about it. And it looks like it's about 52, 53%. So more stocks are outperforming the index. And part of that might be, Apple has been relatively weak compared to some of the other ones. It is off its lows. Don't get me wrong there. But it's sort of, closed right around 200 on Friday, and it's been a little sideways. But yeah, and you tend to see this, in 2022, looks like about 60% of the stocks outperformed its index. And 22 was a bear market, and you had some of the bigger companies faltering there. You have to go back to 2016 for the last time besides 22 that more than 49%, its median average since 1990, outperformed the index. What does this mean? It means there has been, well, it's two things. One is you could say, well, some of the biggest companies haven't really been outperforming as much, haven't been dominating the index. The other is that things are broadening. So, and you would say the bull case would be, well, what if these big companies, what if Apple all of a sudden starts to really move again? Or what if NVIDIA really starts to move again? Remember, semis crested out in, was it 23, I think? And you look at something like the SMH and it hasn't made new highs. even while all these companies are spending CapEx money on AI, which is a different discussion. But it's just kind of an interesting point to make there. All right, we haven't taken a listener question in a while, and we got one from Andres. And Andres said, "Thank you for teaching a great podcast. Thank you, Andres. Trying to understand calendar spreads and diagonal spreads. Can you please explain the difference and when we can apply the strategy? Been learning so much from you guys. Not taking a break from the podcast like the other guy." Yeah. Jay will be back at some point, but I've been doing these solo for a bit. But he'll be back. We've talked about doing one, at least regrouping for a bit. All right. So a calendar spread is where you take. So think about it. If somebody says, "Well, I'd like to buy a call option, for example, on XYZ is now an actual company, right? So ABC. So ABC company, totally fictitious company. And you say, well, I'd like to buy a call on it because I'm kind of bullish, but it's a little bit, it's pricey." And you say, well, maybe I think a move's going to happen, but it might not happen right away. And so one could, for example, we're coming up in June. You might say, well, I'll sell a July, let's say 245 call option, and I'll buy the October or September. Yeah, September. Let's do September 245 call option. So it's called the calendar spread because you're selling the near one, and you're buying the far one. And what happens is, if the stock goes up, that's still generally okay, but you have more time decay on the near term one that's going to expire sooner than you do on the far one. In a perfect world, it expires at 244, and change expiration of the the July one, and then you're left with this call. What it does though is it takes in some premium, so you reduce your cost, and if you're kind of bullish, but you don't think a big move might not happen right away. It's a way to sell some volatility and reduce the price. Now, a diagonal spread, same thing, uses different expiration dates. Normally, you're selling the near expiration, buying the long expiration, but here using different strikes. So, a diagonal would be, well, maybe I'll sell the 250 for July, and I'll buy what did I say, October or September? So sell the 250 for July instead of the 245, and then buy the 245 for September. And you're just using different strike prices, so you can vary. You can vary the P&L graph. You can vary the potential profit. Without getting too involved with these, that's kind of the general idea. And some people might be asking, well, why do you always sell the near term one? The reason why is because if you sell the far one and you buy the near one, you're buying more time decay. You're buying something that decays quicker. But also, you would be treated as naked there because that first one, the long one's going to expire before the further one out. And that would be treated as a naked position. And then if you hold that naked position after the first one, then you really have unlimited loss there. So that's the quick and dirty on calendar and diagonal spreads. All right, finally, uninverted. Again, I've stopped watching this that closely, but for those of you keeping score at home, the 10-year Treasury interest rate is 4.41%. The 3-month Treasury, this is the one that matters, not 2s and 10s, but the 3-month. Cam Harvey, who came up with this, used the 3-month and the 10-year Treasury. There's 4.36. So we're uninverted, but what's interesting is the 2-year is 3.89, so it's 3 months are inverted with the 2-year, and it's inverted all the way, 7, yeah, it's inverted with 7. So really 1 year through 7 years, it's still inverted, but it's uninverted. And then, of course, the 20-year 4.93, the 30-year 4.92. So it's kind of it almost looks like a cup with handle, the chart, or kind of like I don't know, you have a line, a dip, and then it goes up and to the right. So what does this mean? Well, the 2-year is pricing in that rates will be lower. And if you think about the 2-year is sort of the market's forecast about where interest rates may be going. And if you believe the 2-year, if you think the 2-year is right, you would say that it's probably likely the Fed lowers rates and they lower them to, get them down to like 3.75 or something like that, which would be, if that's your effective, that's about 65, 75 basis points in lowering. So call it 3 cuts. Is that likely to happen? I mean, that's not what the Fed funds futures are pricing right now. And I always tell people, be careful about reading the probabilities of these because they will change. But basically, they have 2 interest rate cuts by December. And if you're 2 interest rate cuts, did I do the math wrong? It'd be about an effective Fed funds rate about 3.79. So yeah, that would uninvert it. So look, if you believe the 2-year, rates apparently based upon the 2-year could go lower. Remember, the market, though, it's not a hard and fast thing. And I would say that it's very interesting how you see that we call the kind of the belly of the curve. The belly of the curve is kind of just sitting there in the low spot. So I don't know. I mean, I always keep saying, be careful what you wish for, because if the Fed is aggressively cutting rates, and they're not going to do it just because the 2-year is where it's at, but if the Fed is aggressively cutting rates, you would say there's some problem in the markets. And so that's why I know everyone wants rate cuts, but a lot of people are, really betting on or voicing their own opinion or their own self-interest, I should say. People want low interest rates because it's easier to buy a home, to refinance a home. A lot of people still have very cheap mortgages. I know I talk to people all the time, or 2.875 or 2.687 or something, like that, and locked it in. But I don't know. I mean, when you look at some of this stuff in the economy, if you look at a site like EconPi does an analysis, and they have a median of coordinates, and things that are in the decline quad are things like retail sales, building permits, vehicle sales, unemployment claims. There's also stuff in the expansion quad, something like the credit manager's index, the yield curve spread, hires, temporary unemployment, recovery quad. And then you have contraction, small business optimism. Remember, that's soft data. That's like the surveys. You ask people questions, I don't think things are going to be very good. Are they right or are they not right? This is a self-fulfilling prophecy because they're pulling back. Are we really going to have inflation of 6.6%? So far, the hard data, the actual numbers, doesn't say that. And, existing home sales is in a contraction quad. So I'll if you just go to econpi.com and you can kind of research that a little bit. But I don't, so far it's a little bit mixed, the hard and the soft data. So I'd be careful looking at soft data. Soft data is what people think. Hard data is what actually happens. And, I mentioned it at the top of the show, the Atlanta Fed GDP Now forecast. Pretty darn good. If you look at the GDP Now, the last one was 3.8% for Q2. And that sort of really shot up. And if you look at some of the subcomponents, I mean, a big part of this is net exports is coming way back. So if you look at net exports of the 3.8%, what is it? Net exports is 1.45 of that, meaning 3.8 minus 145 is the rest of the stuff. Kind of like we did when net exports was the problem. And then you look at consumer spending is positive, non-residential fixed income positive. Remember, this is a nowcast. This is what, as data comes in, it's sort of updating the model. The closer you get to an actual release, remember, we're in Q2, so we're not close to a release. Q2 isn't over until the end of June. So not until July we have a first estimate, end of July, first estimate for Q2 GDP. But you're looking at this, and government spending is positive. Change in private inventories, that's a negative one. Residential investment is a negative one, but 3.8%. So I don't know. I mean, it not unsurprising given that in the first quarter it was negative. What do we say? Negative 0.3%, and net exports was minus 4.83. Meaning, if you take 4.83 plus if you know what I'm saying, like make that normal, GDP would have been positive in Q1. So we'll see. Everything people think is the easy thing to predict isn't necessarily easy. I'd be careful of that. That's why we like to stay invested, be hedged. We don't try and pick tops and bottoms of the market. And if you want more information on that, derek.moore at zegainvestments.com. That's derek.moore at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly. If you can't spell that correctly, you're not going to be able to email me. But email questions too. We like taking those. Forward this episode or any other shows to friends or people who aren't friends. And if you're going to rate it, you got to put 5 stars. If not, don't bother. I don't think it helps. I don't really know if rating it helps, but just forget about the rating. Just forward it to someone you know or don't know. All right, that's it. Recommendations: Stanley Cup Finals rematch, Edmonton Oilers against the Florida Panthers. And then I'm watching a show. I'm through a few episodes. What is it called? The Judge. Bryan Cranston's in it. It's on Netflix. And it's look, I think he's a great actor. And, he was in Breaking Bad, of course, which is one of his seminal roles. He's been in a ton of movies. Yep. So The Judge on Netflix. Is it The Judge? No, it's called Your Honor. Your Honor. But he is a judge. I'm not really giving too much away because you'll find that out really, really soon. But I'm through the first couple episodes, and I think I got to give it a buy recommendation. I think it's worth checking out. I'm going to stick with it. I didn't get a chance to look at all the episodes yet. So far, well, it says 2 seasons. It says 2 seasons. Maybe they came back with another season. I don't know, though. Let me take a look at that. You know what? I don't know. I didn't know there was a second season. All right. Well, there you go. The Judge, Stanley Cup Final. Not The Judge. Your Honor on Netflix. Worth checking out, I think. And then Stanley Cup Finals, NHL playoffs. Edmonton Oilers rematch against the Florida Panthers. That starts Wednesday, I believe, June 4th. That's it. That's all I have. Good luck, everyone. Talk to you next week.